One of the most important things that we look for in a long-term investment is whether the company has an economic moat. Companies that have such moats will almost certainly provide supercharged profits and solid share price growth for years and even decades to come.
In this video, we're looking at what an economic moat is, the attributes that can give a company an economic moat, what we look for to identify them, and, of course, some examples of stocks that we think are well guarded by an impenetrable economic moat. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
First, we want to give a special shout out to Stake, who are sponsoring this video. Stake is FCA regulated and offers unlimited commission-free trading in real time in over 3,700 US stocks and ETFs.
Stake has fractional investing too, so you can easily afford to buy highly priced stocks like Amazon and Google.
And Stake are giving away a free US stock worth up to $100 to everyone who signs up via our link. We'll put the link to the offers page in the description below, so be sure to check that out. Now let's get into the video. What is an economic moat? The term economic moat was popularised by Warren Buffett and refers to a business's ability to maintain a competitive advantage over its rivals. A competitive advantage allows a business to protect long-term profits and market share and prevents other companies from being able to compete effectively.
Just like a medieval castle, the moat is a key defensive fortification that provides it with a preliminary line of defence. When you invest in stocks which possess a wide economic moat, you can rest easy at night knowing not only that your wealth is well protected, but it's also likely to grow above and beyond the rest of the market.
Morningstar defines a wide moat as where a company whose competitive advantage is expected to last more than 20 years. One that can fend off their rivals for 10 years has a narrow moat, while a firm with either no advantage or one that will quickly dissipate has no moat.
KFC is a brand that has a wide economic moat. No other chicken comes close, and they will be able to produce exceptional profit margins for decades to come. KFC is part of Yum Brands, ticker YUM, and is traded on the New York Stock Exchange. It's worth remembering that a wide economic moat doesn't automatically make a stock a good buy if it is already factored into the share price.
No economic moat. It's best to avoid long-term investments in companies without a moat, because it is far too easy for competitors to swoop in and steal market share, undercut prices, or even produce a superior product that would cause the profits of your stock to erode over a short period of time.
For example, let's say that you're interested in investing in a retailer that sells video games. This product could be considered a commodity because the games are mass-produced and identical no matter where the customer buys from. Therefore, it makes no difference whether the customer buys from retailer A or retailer B. In practice, these retailers can compete on more than just price, but the majority of customers will base buying decisions for video games on price.
Retailer A can get a short-term advantage by bulk buying from the distributor and obtaining a lower purchase price. It can then undercut the prices of retailer B. However, retailer B can quite easily employ this technique themselves and eliminate the brief advantage. Worse still, the entire video game retail industry is at risk from the hardware manufacturers, such as Xbox and PlayStation, finally deciding to go completely digital and eradicating the need for retailers at all.
Wide economic moat. A wide moat is typically something that competitors cannot reproduce. For example, Apple and Google have huge competitive advantages when it comes to the sale of apps. App developers are charged 30% commission by Apple for each sale or in-app purchase, and you have probably heard of the recent ongoing skirmish between Apple and Epic Games.
The problem is that app developers have nowhere else to go because it's not easy to download apps from anywhere else other than the Apple App Store, as it's restricted on iPhones, or in the case of Google, heavily discouraged. This effectively gives Apple and Google free rein to charge whatever they like and assures future earnings.
Likewise, it is unlikely that another mobile operating system will challenge Apple or Google anytime soon, because there will be a substandard availability of apps, so nobody would ever buy that phone, therefore guaranteeing its demise. If even Microsoft couldn't crack the mobile operating systems market, what chance does anyone else have?
Economic moat attributes. Sustainable competitive advantage is easy to explain but not easy to prove. Does the company have one? How durable is it and how long will it last? These are not easily answered. Here are some of the attributes that can give companies economic moats, and it's not uncommon for companies to have multiple advantages.
Number 1. Network effect. The network effect occurs when the value of a company's service increases the more people use its service. For example, Facebook owns multiple social networks that get their value from multiple users using the platforms. Take WhatsApp for instance, which was bought by Facebook in 2014 for an astonishing $19 billion. They only paid $1 billion for Instagram back in 2012, so this alone shows the expectations that they have for WhatsApp.
WhatsApp now has over 2 billion users worldwide. How can any other app ever compete with it? If you were to download an alternative app, there would be nobody that you knew on it to contact, rendering it unusable. We're really interested in seeing how Facebook monetize WhatsApp going forward. The goal is to have people communicate directly with banks, airlines and so on over the app. For 2020, the potential revenue is expected to be $5 billion, and we can only see this climbing ever higher. The impenetrable economic moat around Facebook's family of social media platforms is why we both recently bought Facebook stock. Let us know down in the comments if you're doing the same.
Number 2, intangible assets. Next up is intangible assets such as patents, brands and licenses that can prevent competitors from duplicating a company's products or allow the company to charge a significant price premium.
Pharmaceutical companies that have patents on their drugs can effectively charge whatever they want, knowing that other companies cannot copy them until that patent expires. Once it does expire, generic drug manufacturers will enter the market and push the price down, but for as long as the patent lasts, the company has a competitive advantage.
Number 3, cost advantage. Companies with cost advantages can either undercut competitors on price or can charge market level prices while earning higher margins. For example, some oil companies can produce oil at far lower prices than anyone else. Saudi state oil giant Aramco has the lowest production cost of oil in the world at just $2.80 per barrel. However, US shale oil producers need crude to fetch a price that is more than 14 times higher to cover their costs. This is why Saudi Arabia can drive down the oil price and destroy the competition.
Number 4, switching costs. It is sometimes too expensive or troublesome to stop using a company's products and switch to an alternative provider. We consider Adobe products to have high switching costs.
Creative products such as video editing, photo editing and motion graphics are very time consuming to master, and Premiere Pro, Photoshop and After Effects are already the industry standard. They are also interconnected, which provides additional functionality and benefits to users. It would take significant time, effort and training costs to transition to alternative products.
Number 5, size advantage. Being big is usually a massive benefit. At a certain size, a firm achieves economies of scale, and overhead costs are spread over more products, thus reducing the cost per item. Amazon will be able to obtain lower procurement prices from its suppliers than any of its competitors, because Amazon can buy in quantities that no other retailer can match.
Not only that, but buying decisions are often based on who is biggest in the market, as it is common to assume that the biggest equals the best, and therefore the biggest get more sales.
How to find stocks with an economic moat. Judging the size of a company's economic moat is very difficult because it's a qualitative measurement, meaning it's subjective.
For some, it's just obvious. For example, Coca-Cola doesn't need to change the Coke product and it will continue to sell around the world. But a car company needs to regularly improve their product offering, otherwise the company will rapidly die. Likewise, Nokia found this out the hard way when they failed to meet the expectations of their customers.
The best way to identify an economic moat is when you are familiar with the product or the market. Do you use the product, and is it better than the competition? Here in the UK, we know that Rightmove is the #1 property website because we are users and personally understand the market. If I was selling my house and my estate agent didn't list my property on Rightmove, I would quickly sack them and find a better estate agent.
A telltale sign of a moat is having fantastic quality metrics such as return on capital, return on equity and operating margin. You'll want to compare these to other similar companies and see how they stack up. We personally use Stockopedia because they make it dead easy for us, but you can also find this information on other sites or do it the old-fashioned way and calculate them yourself.
A company with an advantage should have a superb record of growing revenues, profitability and cash flows. If we look at Adobe as an example, we can see that the key metrics are all superb, with return on equity near the best in its industry and the wider market. We can also see that its health trend is fantastic and bankruptcy risk is low.
If we then take a look at its key financials, we can see revenue consistently going up year after year, so is operating profit. And even the profitability metrics are all improving year after year. So far, Adobe is looking awesome. Cash is king though, and we're not disappointed, with free cash flows per share rising every year.
Combine the financials with what we know about its products and we can safely say that Adobe has an impenetrable economic moat. But there's always a but. This awesomeness is potentially already priced into the share price. You can decide whether it's worth paying for. What we tend to do is find quality companies, and if we think they're too expensive, we'll add them to a watch list with an alert set to warn us if it gets to a more acceptable price.
If you want to buy any of the US stocks mentioned in today's video, plus many thousands more, then go and check out the stake offer on our website and get your free share.
Question of the day: what companies do you know of that have economic moats and why? Let us know in the comment section. Thanks for watching. On this channel we talk all about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.